Alright, what is up guys? Today we're going to be doing a very simple review on what the market did today. And this is going to be kind of my own way of thinking or seeing the market. It's not necessarily going to be all 100% not true, but like what I think is going to happen is not going to be 100% what will occur. So obviously do your own research. But what I am going to do is going to show you how I think of my process of what I think price will do next, and more importantly why. So without further ado, let's jump right into a daily chart, which I like to see every single time when I start trading. I try to see what the market wants to do on a daily chart on a daily basis, or every candle that you see takes a full day to form, so a full 24 hours. So you can see on the 25th of September my candles are black when it goes down. When it's green, it goes up. So as you can see, these 3 days right here, because it took 3 days to form, all black candles, which means that on all these 3 days, ultimately the market went down. On this one specifically, it went all the way down to here, to this level, which you can see it left a very skinny black line. And all that means is that the market, the participants bought it back up, making it reach to this price level right here. So it can get a little bit confusing understanding what these little skinny black lines, unless you go to a very lower time frame. And then what that means is instead of a full day, we go to a candle that takes, you know, one hour per candle. And then we can really see what happened down here that made the market turn around. But what I kind of want to just review today is marking out the daily fair value gaps, the one that we currently used. And as you can see, I marked out this daily fair value gap. It takes 3 candles to make one. We have this first candle, it's candles high. We marked it out with this blue box. We have the second candle, which the candle is the most important candle, which makes the price go higher. And then we have the third candle that we did not reach back into this candle's high, so we have a gap. And if we grade this with the Fibonacci, we can see how the market didn't reach all the way down to its original starting point of the gap, but it did end up closing way higher than the 50%, which is good to see. And that's how we can see that the market reacted a lot higher. So obviously getting the entry here is the hardest thing to do, because let's say we did get an entry here. Our next objective, if we're still bullish, would be obviously to this candle's, depending on what happened before, would be that candle's high. So this candle formed, right? We ended up closing here. We opened right here, and what probably happened is, we can probably take a look on the 1 minute chart. We can see how the market reacts off of this level. Here, I'm gonna make another daily chart so we can see. So this was the high right here, so you guys can see that. This candle's high right here is this right here, right? So then during that same day, we ended up selling off, right? We went super low down to this low. We ended up going higher, and then we ended up closing around here. If we go over here, so we ended up closing like around here, right? And then the next day, we ended up going a little bit lower. During the day, we went all the way to the high. So we took out this right here. In other words, we had this high that finally got taken out, right? And then we ended up going, okay, we went to this high, which would be forming this candle's high. So we leave this right here, right? So in other words, that's our liquidity that we have left. And then looking at the daily chart, we can see that what I marked right here is going to be this, that same line right there. Now looking at this, we can see how we can expect that the market on the daily chart is going to want to reach into this daily fair value gap. And when it comes to the daily fair value gap, we now have liquidity right here because this candle has yet to form, right? Pretend like it doesn't even exist. To make it easier, maybe I can. So this is how it looked like before, right? We have yet to see this candle form yet, but we can anticipate after this drop down that the market would want to come back down into this fair value gap, and we would anticipate it to reach at least to the 0.5 level. We wouldn't want to see it come down below than this, but we can see how it kind of went to the 0.25 level, and that's being shown right here. When the market comes down into here, we can see this right here. This is how it's forming, right? So if we really zoom in into here, we can see how the market dropped down, but looking at this is where I would be anticipating a setup. As we can see that we have our Fibonacci on this daily fair value gap, and more importantly, how we can see how we formed another fair value gap within this fair value gap on the 1 minute chart. But you can see clearly how initially it does not respect it, it goes through it, but the bodies of the candles do stay in between this OTE, which is optimal trade entry, which is pretty much when you put on a Fibonacci, that entry point, those two price points will be the 0.68 level and the 0.75 level. And we can see how the market works its way up, coming back down to the 0.25 level. And after that is where we really see how the price just takes off. But the ideal entry would want to be inside of here in this fair value gap. But we also have that fair value gap that initially did not work. But then we also have this one, and we can also see that this one didn't really work either. Not that it didn't work, but price didn't use it, which is very key. Because if it never uses it, we can tell that the price does not even want to come back into it, and it's giving us a signal that it wants to go higher. But after that, we can see on the daily chart, we're going to skip one, so forward one, and we can see immediately how price right here at 6 o'clock the next day, we opened right here. And on that, since we opened right there, we can see from the whole day, we never come back down into that price point, right? So we're going to mark out, this was our open, this was our close. That is a very specific price point where it's important because we never went back down into it, and it's a new day opening gap. And we can see how we had our liquidity up here, right? When we never took it down, this was our low right here. And then we can see how it kind of just keeps them going higher into it. And then we can see how we finally got into, you know, the liquidity that where we dropped from at this point, went down into the fair value gap. And then the next day we opened here, and then we went straight to it, a little bit higher, right? A little bit higher than that, really. So this was our ultimate high on that daily candle. And then from there on out, we can see how price, I really like this, how price touches this. And now we're finally lower. So as you can see on the daily chart, 15-minute chart, 1-minute chart, it's all showing the same thing. If we label out this old high that we had before the market dropped, we did go higher again. And then finally we went below it, into it, and then we're going down lower. So now what I'm trying to see is where a place if we want to go lower, where would that be? And for me, what I'm looking at is this right here. We have a fair value gap there on the 15-minute chart. We now have two here. So I'm gonna label out this one. So overall, what I'm trying to say for the market is it is looking kind of bearish for the short term. I do think overall it's gonna be pretty bullish for a while. There's no reason why the market should go lower dramatically, in my opinion. But I do think there is a correction that needs to happen, because we have been just going higher and higher for a very long time now. But that doesn't mean that it has to happen today or next week. But yeah, for short term, I definitely do think price is going to want to go lower. I'm just going to label this other fair value gap with some lines so that I don't have too many red boxes. So on a 15-minute chart, we have this fair value gap here, and then we have the higher one. If this one fails and it wants to go to here, it could be a sign that we are just done taking a small correction. Not a correction that I want to see, but a short term to go higher. I do want to see how price can come back down into here. And then we also do have this, what I labeled before, a new day opening gap. We had the close, and then we have the open. So I do want to see how price would want to come back down into here. But yeah, we do have liquidity internal. So meaning liquidity usually means like the very low or the very high. But we also have liquidity in between it, which is internal, which I want to see how it reaches into here. So ultimately what I'm trying to say is, for now, I don't want to see price going higher than here, since we already kind of did its work here. We took it out on the first one here. We had a second one here. We already took that one out as well. And now I want to kind of see it do the same thing, but on the opposite direction. But yeah, I think that's going to be it for the review for today. This is on the NASDAQ 100, so top 100 companies. And as you can see, we do have a micro account. So if we were to place a trade, this is just fake money. Let me take out one contract. So one contract, and let me put positions, meaning one contract, every price move is about $1.25 based on an actual mini contract, which would be a full $12. So you can get taken out of the market pretty fast if you don't use a micro account, which I'm using here. So as you can see, if we put our stop loss right here, it'd be $41 on a micro account. So if the market wants to reach up into here, we'd be losing only $41 compared to a actual e-mini, a full contract. It'd be times 12 or times 10. So that short of a move would be minus $400 compared to 41. And the same thing right here. So this would be my trade setup, let's say. We click confirm. This is all fake money. So as you can see, this trade setup would net me 205.50 cents, around 400 ticks, 411. Stop loss would be minus 82 ticks. So there's a good amount of price movement. There's a lot of, what do you call it? Room to breathe. But when it comes to full contract, not a micro, but an e-mini, we could easily just lose a couple $400 in a couple minutes, which is not ideal. So I am going to be moving to a micro account And the main objective of using a micro account is to open up a prop firm account, like Apex or Top Step, and using one of those and kind of doing the same review as I'm doing right now, but actually taking trades on that prop account based on what I'm thinking in the market. So that's definitely going to be one of my next videos, and showing you guys how I do that. Right now it's just going to be kind of just reviews, daily reviews, just putting out there what I think the market's going to do. Not too long, not very detailed or explained a lot, but just simple, just this is what I think. And yeah, see you guys.